Hello, our discussion today is entitled Facebook is being investigated by the IRS. And indeed, this is an international story. The story takes us to Ireland. And so if you remember recently we were in the United Kingdom. Now we're just across the water in Ireland. And the distance between Portsmouth, Virginia and Dublin, Ireland is about 3,446 miles across the Atlantic Ocean. The issue here, as is becoming more popular, is that Facebook has decided to try to pay the lowest taxes. And so Facebook performed a complete and complex maneuver to lower 2010 taxes and taxes beyond that. It transferred property into its Irish subsidiary. And the property included hard-to-value assets. One example, and there's more than just these two, but these are examples, user-based online platform, and marketing intangibles. Well, what do we mean by user-based online platform and marketing intangibles? Well, a user-based online platform is a learning management system or online library of content, kind of like Blackboard, which we use for this class, or Facebook itself. How much is that worth? Imagine trying to put a value on that. Marketing intangibles are marketing things done by a firm that doesn't own the trade name and receives value for the use of these things. One example of this could be a trademark. The Internal Revenue Service believes that Ernst & Young, which, by the way, is the firm I started my career with. I worked in the Columbus, Ohio office, and I don't think that office was the one handling this. But Ernst & Young, on behalf of Facebook, may have under-recorded the hard-to-value assets by billions of dollars. And as I'm going to show you with an example a little later on, if they undervalued by billions of dollars, then that means the tax assessed was short by billions of dollars. This came about because Ireland has a low corporate tax rate. This is becoming more common and more popular. Countries are realizing that as the world becomes more global, if they have a low corporate rate, companies from all over the world will go there. Already, as part of the negotiations with the IRS, Facebook has agreed to route United Kingdom sales through the US rather than through Ireland. And the US corporate tax rates, as I'll show you in a little while, are higher. So the message here, or the moral, is that soon the IRS may hand Facebook a large tax bill. Here's what the issue turns on. The Irish corporate tax rate is 12.5% for ordinary earnings and 25% for non-ordinary earnings. Now, when I show you the example in a few minutes about the undervalued assets, this does not directly play into the different tax rates. So the tax rates I'm describing here are for the earnings that come later from ordinary Facebook transactions, most of which are marketing. So as the Facebook Irish subsidiary collects fees for marketing, it's going to have to pay 12.5% on those ordinary earnings. And if it later did an asset sale, like the one in this transaction, it might have to pay 25%. But look at the difference below in the US corporate tax rate. So if those ordinary marketing transactions where Facebook was collecting marketing revenue went through the US, then the tax rate could be anywhere from 15% to 38%. And what I'm telling you in this last sentence is that at low amounts of income, heading from 15 to 38, a corporation would benefit. So that, just as a very simple example, and this is not correct, I'm just making it simple so that you understand it. If 15% applied to the first $1,000 and 38 applied to the second $1,000, notice the combined tax rate would be somewhere like 25, 26, 27%, because the first 1,000 would be taxed at 15, the last 1,000 taxed at 38. Well, in truth, the rate's more graduated than that, but at some point, the tax rate is no longer 15 to 38. It just becomes a straight 35%. And what we're getting at here is, at some point the IRS says, no, you can't take advantage of these lower rates, 15, 20, and so on. On the other hand, we never meant to tax things as high as 38. So if you get beyond a certain amount, then the rate's 35. Now before we leave this slide, look again at the fact that normal Irish corporate tax transactions are 12.5%, whereas in the US, for a company like Facebook, normal tax transactions might be 35%. So yes, one of the things IRS is doing here is trying to collect some tax they think they're owed. But a bigger thing is they're trying to penalize Facebook a bit, because from now on, Facebook will be paying tax to Ireland rather than the United States, but they'll be paying tax at a much lower rate. Okay, let's look at an example, and then I've done some economics graphing after the example, but first to understand the example, and the graphing does apply to the example. So suppose that we're comparing the Ernst & Young value that they assigned to Facebook and the IRS value that they assigned to Facebook. Now these numbers are not real. I did not get these numbers from the actual case. I made them round numbers and I made them large but easy to understand. So they're just my made up numbers, an example of how this could have gone. So it could be that the user-based online platform was valued by Ernst & Young at $400 million. And perhaps IRS thought that the value should have been $750 million. Notice it's almost double what IRS thought. Then Ernst & Young might have valued the marketing intangibles at $125 million, while IRS valued them at $250 million, double. Notice then that when you add the two IRS values together, you come up to $1 million. I'm sorry, $1 billion. You come up to $1 billion in value. Whereas the Ernst & Young value is only $525 million. Notice the difference, almost 100%. The difference is $475 million. Okay, let's apply taxes. I've kept this simple, and in some cases the IRS might use slightly different language, but the result, if this were the set of facts, would be the same. So Ernst & Young, notice, most likely computed a value like $525 million, and they suggested that Facebook Ireland pay Facebook US that amount to buy the assets. So then if Facebook Ireland pays Facebook US has no gain in the United States. Well, if they have no gain, notice there the gain of 0, and you multiply 0 by any number, including in this case 35% tax, you come up with 0 tax. Now, to the right we have what IRS thinks the value is, $1 billion. So if Facebook Ireland paid the Facebook US $525 million, the IRS says, no, you really gave away $475 million to your friends, and you can't do that. If you do it, it's as if you had more income. So they're going to look at that $475 million gain. They're going to tax it by 35%, the U.S. tax rate for capital gains for corporations. And the tax on that is $166,250,000. Notice it's not really significant, but if the Facebook Ireland had overpaid for the assets, then indeed IRS would have also slapped a tax on. The big thing to note is that this difference of opinion between IRS and Ernst & Young creates a different tax result of $166,250,000. So I've attempted to put this in terms of welfare changes as we've been studying. So I've got the welfare changes from the tax loss. I've made up some numbers in this. So you know, this approximates what really would happen, but some of these numbers are made up, and I'll tell you where. So I did look up and notice that there are about 1 billion Facebook accounts in the world. And so the quantity here on the horizontal axis is Facebook accounts. I made the assumption that Facebook makes approximately $50 in marketing fees per account. So then we have, if Facebook US continues to operate, the costs there might be $40 per account. So then Facebook can charge $40 for marketing fees instead of $50. But if Facebook Ireland comes along and is able to do it more cheaply, in this case because 166 million in tax was saved, well, now the cost of marketing for each Facebook account might only be $25, not $40 anymore. So if we have our demand and supply curves crossing at 50, then we have the US price at 40, then the Ireland cost or price at 25, the welfare areas are A, B, C, D, E, and F. So much like we did in the welfare discussion last week, we can look at what happens with international consumers. This includes U.S. consumers, but it's not limited to U.S. consumers. Notice they gain everything between 40 and 25 because the costs are lower now. And in theory, Facebook can pass the costs on to them. So the U.S. and world consumers gain C, D, E, and F. The U.S. government taxpayers, though, I'm saying the U.S. government and the taxpayers, not implying that the U.S. government is the taxpayer. But the U.S. government, representing its taxpayers, lose D, E, and F. So all international consumers, including U.S. consumers, gained C, D, E, and F, but U.S. taxpayers lost D, E, F. U.S. Facebook producer partners, not Facebook itself, because they managed to move to Ireland, but anybody else that Facebook does business with that operated in the U.S. that Facebook no longer does business with lost in C. This brings us to the complicated result, much like we saw last week, that U.S. consumers gained C, D, E, and F, but they lost D, E, F. There was a net pickup of C. Sometimes this leads economists to overly simplistic conclusions, and the economist might say, so this was a net gain for Americans. But it's not that simple. It is a net gain for Facebook users. But what about those who aren't Facebook users? Those Americans lost some tax, and that means they're going to have to pay the difference or lose in services, not getting the same government assistance or service that they used to. But they didn't benefit because they weren't Facebook customers. So as often the case, this is a more complex thing than it first appears, but you could look at this graphically, make some basic assumptions, and decide whether there was a welfare gain or a welfare loss. Well, take care, and I hope to see you again soon. These next few slides just show references. This primarily came from a CNN article that I cited at the beginning, but certain things like the definition of marketing intangibles and online learning platforms, I went ahead and got additional information for you because those weren't well defined in the Facebook account or in the Facebook article. I'm sorry, in the CNN article. Take care.